US business sentiment hits a 27-month high ahead of inflation data on Friday. Welcome to Market Insight, I'm Thomas Warner. Flash S&P Global PMI data out a short time ago showed that US business activity edged up to its highest since April of 2022 at 55 versus 54.8 in June. Services activity rose, but the manufacturing sector fell into a surprise contraction. Second quarter GDP and the PCE price index will follow on Thursday and Friday respectively, and nobody will be looking closer at this week's data than the policymakers at the Federal Reserve, ahead of their next meeting on July the 31st. With me to share his thoughts is Satyam Pandey, Chief US and Canada economist at S&P Global Ratings. A very warm welcome to you, Satyam. Let's start with those S&P Global Flash PMIs for July. What do they tell us?
Well, it's the same story on repeat. Service side of the things are doing quite well, while the manufacturing side has been moving sideways. In the first half of the year, we thought manufacturing was probably starting to hit the bottom and come back up. It seems like it's just going through that 1 month volatility is still there. It may be starting to find some traction, but still maybe interest rate cuts will help it more than anything else.
Well, Satyam, we are going to come on to those interest rate cuts because you've obviously made quite an interesting prediction on that front. But first, let's move on to GDP and inflation on Thursday and Friday. Your forecast for GDP growth is actually higher than the consensus. Why is that?
Well, we have our second quarter GDP growth at somewhere between 2 to 2.5%. That's what we've been saying since last month. And it seems like data is building in to become just that. We do have to point out that our own consumer spending growth, investment growth, they seem like they're more in line with the trend growth rates rather than anything else. We are past last year's 3+ gains that we saw. I think we're more closely in line with 2%-ish, 2 to 2.5%-ish GDP gains for this year.
So what were the main factors in the second quarter driving that GDP growth, do you think?
Well, it all comes down to consumer spending. In the first quarter, we saw consumers, their expenditure growth coming in at 1.5% on a quarter-over-quarter annualized basis. This time around, we think it is going to be more closer to 2% or a little bit higher than 2%. And given the fact that it's 2/3 of the GDP comes from the consumer sector, that automatically brings up your overall GDP growth. At the same time, we do think that equipment spending may have increased from what we had in the first quarter as well. So overall, both business spending and consumer spending may give a little bit of that upward growth impulse for the overall quarter.
And you see inflation slowing another 0.2% in June, is that right?
Yes, we do think that inflation will slow down. The PCE core that the Fed likes to look at should be coming in somewhere between 0.15 to 0.2% on a month-over-month basis. We saw the CPI and the PPI come in 2 weeks ago, so it all points to that direction. And that would bring the year-over-year core PCE down to about 2.5%, which is not yet at the inflation target level, but still, it's making its way there.
Well, let's talk about the Fed then, Satyam. Do today's numbers have any impact on your prediction that the Fed will make its first cut in the fourth quarter, even though the CME's FedWatch tool puts the chance of a September cut at more than 93% at the moment?
Well, the data has been breaking more on the downside, meaning for inflation, it's been underperforming than what we had expected. So the needle is moving towards a September rate cut. It may be a 50-50 toss-up right now. There is a couple of more inflation data coming in between now and September. If it does indeed come the way that we have seen the last couple of months and unemployment rates, drifts up yet again, we do think that it may be September more than December. But for now, before those data come in, we are still in the camp that it may be the fourth quarter rather than September.
We will have to wait and see, I suppose, but let's look at the corporate side now. Q2 earnings season is in full swing. What have the results so far shown you about the state of the US economy?
Well, the state of the US economy seems to be steady as it goes right now. The earnings season is in full swing, and we've seen some of the positive surprises in earning estimates. And a lot of the smallish businesses also have shown some resilience. So we would think this may be an economy that may be slowing down from that unsustainable pace of second half of last year, but it is still holding on to a trend-like growth rate, which is a good thing overall.
And just finally, oil prices are down 7% on the week at the moment, close to 6-week lows. How would that affect your outlook for the economy and for Fed policy?
Well, obviously, it is going to be helping the consumer sector. A lot of the expenditures in the oil gas pumps, those are going to be a little bit less. But again, overall, it is going to make the inflationary impulse move down a bit. So that would be a net a positive confidence building for the Federal Reserve to start its easing cycle.
Chief US and Canada economist at S&P Global Ratings, Satyam Pandey, thank you very much indeed for your time today. And that is your Market Insight. You can watch more videos on Reuters.com.